Hello everyone, today we got a lesson on chart patterns. The last video was a breakdown of just core market structure, right? Support, resistance, how to use channels, how to use trend lines and stuff like that. This video is going to be showing you guys how most of the trading within consolidations is done. Now, you guys can look at consolidations within the market as something that is a sideways trading pattern, right? But let's say you're able to identify what that sideways trading pattern is just because it happens repetitively within the markets. And let's also say that you're able to trade that with a lot more confidence than your average day trader or somebody who doesn't really look at the markets because you are familiarizing yourself with more of the technical analysis side of things. So this is where you would get more of your precise entries, I guess you can call them strict stop losses. And these patterns are meant for you guys to trade if you know what you are doing. Now, some people, they don't like to trade consolidations within the market. A lot of the time, you get a lot of momentum traders or momentum investors who like to buy a stock or short a stock just because they are going down or going up rapidly. In this case, you are giving yourself and positioning yourself the best opportunity to either buy or sell an asset just because you're able to either add more to a position if it is looking like it's going to become a winning one or is already a winning one. You can cut your losses early. You can close your entire position early, as opposed to something just moving rapidly up or down extremely quickly. Now, in order to avoid some of the common trading mistakes that we will go through in future videos, it is extremely important to keep your trading and patterns strict. If you see something that is going against the rules that we will look at today, it is ideal to get out of that trade and not chase it. More patterns will come. You will be right however many times in your life, but if you cannot learn to handle this, like the losses in your trading or investing, you will continue to lose time and time again. And I've been there. I've seen it firsthand personally. So my advice to you guys, just let the market come to you. Anyway, some of these patterns are going to be more common than others, and you guys just have to be ready for when you see them. Let's start off with the two most common ones, the head and shoulders and the inverse head and shoulders. The one thing that is also common between all of these patterns that we see here today is we trade within support and resistance lines. The red lines, as you guys can see my little legend, are going to be red, and the support lines are going to be green. In this case, if you're selling an asset, you want to enter on the resistance lines. If you're buying that asset, you want to be buying on the support lines. And ironically enough, you are selling when the stock or crypto or whatever asset it is going up. You're shorting when the asset is going up, and you are longing when the asset is going down. So it takes some sort of emotionless trading to be able to pull the trigger and make some of these trades. Okay, I've ranted about that way too long. All right, let's actually look at some of the chart patterns themselves here. When we look at the financial markets, there's a couple of patterns that are going to present themselves more often than not. They are the head and shoulders patterns and all of these triangle patterns, with the exception of the contracting and the expanding triangle. These are seen on larger time frames. These are seen on shorter ones, so you'll see these a hell of a lot more. And obviously the bear and bull flag, I can't leave them out, but there's a nuance to this, which I'll explain. But starting with the head and shoulders patterns, the two most common ones. What are they? This pattern is similar to us. We have our neckline, or our support, which keeps us up. We have our head, which allows us to think straight and make decisions. We have to come back and trade into that support level to keep us still standing for a bit longer. And what comes next? Our right shoulder. So it's just two areas of resistance meeting without trading above the head. Our shoulders cannot go above our head, at least to my knowledge. And what do we do here? We come and we trade past that neckline. So this is ideal if you want to short the markets or if you're looking to get out of them, because a lot of the time this is going to be what a market peak looks like. And if it's not, it's probably going to look like a very confusing pattern at the time, but will still make sense in 2020 hindsight. This is where you're selling an asset or looking to possibly take some profit if you're already in profit and would like to buy back lower and compound, similar to how we discussed in our course. But in this case here, this is where you're buying an asset. Let's say this move ends, the regular standard head and shoulders, and you now want to trade the inverse because you see it forming and you want to make some more money and, like I said, compound some of that some of those gains. This is essentially where you would do it. Now, in these two cases, they are pretty simple beyond that, and I don't think I can really explain them more. A lot of the times, if you're looking at, I'll just get this out the way now just because I know that this is going to be another video. A lot of the times, you might simply just get a quick little dip right below there, and the move is done. Like, this move does not have to continue like that. This could literally just be a quick little peak above it, and then, boom, back lower. Which is why you can enter here on the neckline, but it's a lot more risky than entering right where that shoulder was actually formed. Just because at least you have a trade setup from here to here. Like, at least you have a valid first area of taking your profit. So, let's say this was your setup, right? And you're aiming at say, just a peak below there. A 1 to 3 risk to reward. Peaking below there is enough, technically, just because there could be room for growth on the upside. And I know I'm ranting about just the head and shoulders pattern, but I want to get this out the way. But you can easily just peak above here and continue lower, and it could be another pattern in and of itself. Or this move could just very simply be done and you're continuing lower. Similar with the head and shoulders to the upside. Best way I can describe this, actually, hopefully there's nothing on my chart. Let's remove everything. Is NVIDIA. Here's your left shoulder. There is your right shoulder. Here's your neckline. Back to your right shoulder. And boom, we simply just peaked below there. And then what happened? The moment we did that, price action gave you about 100, well, 30% in that time frame, but wow, no, never mind, not 100, 263% since then. And this is a big move because look at this gap. This came after a gap. But what I'm trying to make here, that's way too advanced just for the time being. The markets might disguise themselves as something else, so it's important to really be careful when looking at these things, just because they may not be what you think they are. Back to our chart patterns themselves, and hopefully that didn't confuse you guys and made sense. When we look at the double top, one thing that I want you guys to really pay attention to, remember when we brought up the risk that came with trading at the neckline here? There's also a risk trading at the double top or double bottoms neckline. This is a pattern where price creates an equal high or an equal low, meaning we are using that previous low or high as resistance or support. So resistance here, equal lows, resistance down here. Your ideal entry point is at the double top. But the problem here is a lot of the time, this pattern is going to be either part of a larger pattern, or this is not going to last forever. So we could just peak below or above. You guys get the point. And continue back into the opposite trend. So trying to chase the double tops is not really worth it to me. You'd have a better chance at waiting on head and shoulders patterns. But these do come up a lot in the foreign exchange market. So if you're able to trade them, go ahead. Now onto bear flags and bull flags. Both of these patterns here have to come at the continuation, or have to come of the continuation, I should say. A large down or a large up move. These flags are not just your average run-of-the-mill flags you carry in your car. These are flags that you want to hang up on your damn lawn so your neighbors can see them. But these flags here are just sideways trading because of that initial extreme momentum. And I've noticed it comes at extreme momentum. Pause, extreme pause right there. But yeah, I'll explain. If I could find my tool. Let's say market is trading sideways like this. We break out of it. Here is your flag trading sideways till we can get as close as we can into an area of previous resistance that we can treat as new support. And what does market do? We shoot right back up, and it comes in the form of a flag. Now, this is what really differentiates this from the descending triangle or the ascending triangle, as they are two completely different patterns. Now, the bear flag, your entry is going to be always at the peak of this channel that we're trading within. It's probably going to give you another entry. So even if you're just like a support and resistance trader, a trend line trader, this could be beneficial to you. I'm not saying all of these tactics are going to work for you 110% of the time, but it might work for you in a way that you can sort of mitigate some of your losses just because you are going to stay strict to a trading plan. And if you do so, you don't have to be right every time. You just have to know how to maximize on your winners. But in this case, bear flag, your entry is anywhere off of these support and resistance lines just because we are trading, or sorry, resistance lines only, because we are trading within a confined area. And similar to here, we're able to predict where that next low or high might be just because we can draw out the trend. And in this case, our stop loss, well, mind you, your stop loss on the double top is obviously the peaks or the troughs. It's very nuanced. We can trade above or below it, but I'd wait until we start seeing some sort of structure break within here. But back to the stop losses on our flags. The stop loss on our bull flag is going to come right about there. I'd say at the initial low. It might trade below it just very, very slightly, so you can give it a little bit of room to breathe. But if you're a trader just watching this, do not let it break below this point and just continue off running. Like I said, there's going to be another video where I break all of this stuff down in complete detail and show you guys actual examples. But in this case, I just want you guys to see how they look standard, and then I'll put it behind a chart later. Anyway, you do not want it to break below these points and just start running off. It might just slightly tick below it, and if it does, you have to be prepared for it. Account for that and just continue trading another day. Similar to our bear flag, if price wants to peak just right above it to throw people off, your stop loss is right above there. That's where you're completely out of this trade. Maybe give it a little bit of room to breathe. Next one is the descending triangle and the ascending triangle. Difference between the flags here is you'll see these contract or expand a little bit more, and we'll go into the other two here that are exactly contract and expand. But the descending triangle, continuation of a down move. I think we can also trade this in a non-continuation of a down move, if I'm not mistaken. I don't really trade the descending triangle too much, but I'm trying to remember. I think you might be able to. Ascending triangle, exact same thing. So in both of these cases here, we are trading within support and resistance, and we are getting either larger or we are contracting. And the descending triangle is simply just trading in the downward trend. Ascending triangle, trading in the upward trend. And in order to actually complete the triangle and trade into another direction, because remember, both of these cases here, we had the open area to continue going lower or higher, right? It doesn't look like we're really confined in one area. In this case, in the flags and the triangles, we are. So this is where you're sort of able to predict and mitigate some of that risk when trading at these areas to continue maximizing your potential in your trades. Anyway, are going to be large in nature. Now, looking at them, like I said, it's going to be pretty obvious, but they are going to be expanding. I was going to say extracting, expanding at a very, very large scale. So this can either be a move that looks like a continuation. Where's my tool? A continuation. Just for sake of time, I'm not going to expand it to the extremes of there. Right? Where we already had our move higher. Or this could be us just simply trading at long-term support or resistance. Just keeps getting bigger and bigger and bigger. Like that. Until price just ultimately wants to break out of it. So you're never really going to know. Well, normally the markets come in threes, but you're not really going to know when that last move is coming. If this is a multi-decade move, this is a couple of years, whatever it is, it's going to be extremely hard to put your finger on it. So that's why it's important to take profit. You don't want that move to come and retrace back to damn near, let's say you caught the bottom of every single one of these moves. You'd be lucky to break even minus inflation if this is going over years. And actually turn some sort of profit in the future and have your money be sensible to be invested. So that's why it's important not to be a greedy investor or a greedy trader. But in this case here, your goal is to enter off of every support level if you are a buyer. And mind you, there's trading opportunities within all of these here. But because this is on a larger time frame, it is a lot more ideal to take these trades because you kind of have an idea of when you can get out, at least in the long term. In these cases, it's essentially gambling, I'm not going to lie. You don't really want to be trying to trade against the trend. If this is a continuation pattern and you know that we're going to squeeze out of here, unless you have multiple confluences of a break of structure into the other side, it's not sensible to go and try to trade these and play hero, which is why I stated multiple times in this course, do not be a hero trader. I've learned that in my life. Some of my best moves, I'm not going to lie, have been me hero trading something. I'm not going to go and showboat whatever wins that I've had. But in maybe a matter of 2-3 days, I've been able to compound at maybe 2,000-3,000% on small accounts. And that just, it adds up. Not even just small accounts, larger accounts as well. So just keep these things in mind when you make these trades. Some days you will go on rolls where you're sitting on top of the world, and other days you just gotta sit on top of your hands. Keep these things in mind. Now, when looking at the higher time frame pattern, which is what we're looking at, the contracting triangle and the expanding triangle, like I said, entry points for buying right off of that support, funny enough, in both areas. And your take profit would be right at the resistance line if this is the contracting triangle and you're trying to buy this off of a support level. And off of the support lines, if you're shorting this going into, or sorry, off the resistance lines, I should say, if you're shorting this going into those support lines, and then you're buying off of the support lines. Now, if price does want to just slightly trade below there, I'll say this with the intent and the hope that you guys do not overtrade this. If you guys get stopped out, let's say, and you use proper risks, so you're not being a degenerate and risking too much. On any given one of these patterns here, it's important I explain this. You can easily just re-enter the trade, re-enter the investment, whatever it is. I don't suggest selling investments just because you see these patterns forming and like, all right, let's place a stop loss here. You guys can dollar cost average into some of your positions, and I'll explain in further videos, just real life examples with math and everything. But in cases like these here, you can easily just place another trade, if you will. If you're a trader, if you're an investor, different story. But if you seem to be wrong, at least in the short term, but price just continues to reverse against you, don't overreact. Don't make a huge reaction and let your account size pay for it. But in cases like these, just take your time, and if you see price reversing back, maybe enter another trade. Now, last but not least, we have our pattern on gold. I'm actually going to quickly switch to the monthly time frame and zoom all the way out so you guys can see this pattern pretty clearly. Am I in logarithmic? No, I'm not. Let's put this in low. Okay, perfect. So as we can see, this pattern on gold really started back in 2011. We didn't know what this pattern was back then because it had to take some time to actually play out. But in hindsight, it's 2020. We see what had actually happened, and funny enough, we did peak in about 2020. This is our cup and handle pattern, and I'll explain to you exactly what it is in a second. This is a multi-decade pattern, or it could be a multi-decade pattern. So we see that liquidity build up in the middle. This is all just resistance. Price being pushed down, price being pushed down. We never want to break above it. Push down, push down, push down, push down. And we technically are still being pushed down here, right? So price does not break with some momentum above this level. This is our cup. Now we also see the support down here that forms as well. Right? It looks like a cup. Actually, I might as well just draw it out like with my paint tool. So there's your cup, right? This, like I said, could be a multi-decade move. In this case, it was. It was a 10-year move. And very easily, here is your handle, right? And price starts to break out of there. And pardon my drawing, but this is a cup and handle pattern. So this is a multi-decade move. Ideally, if you're buying an asset such as gold and you see price just consolidating, we've been notoriously bullish forever. Doesn't matter at what state it is. Sure, you broke below support, still bullish. Sure, you broke immediate structure, still bullish. Anytime price of gold is trading just completely sideways, you should still be a buyer. And I'll explain why. Even if you had bought at the neckline of this pattern right here, to current day, you'd still be up. Oh no, that's the wrong tool. My apologies. To current day, you'd still be up. Let's say you were wrong every time. Mind you, you could be wrong every time for 6 years. So for 6 years, you could be wrong every time as long as you don't sell. You're not wrong in the long term. You'd still be up around 81% in a matter of 11 years. That's still pretty solid. Still pretty solid on at least a gold investment. Let's say you bought damn near at the bottom. 117%. So if you are the type of person who likes that slow growth and is willing to wait things out and just sit and collect pieces of gold, shares of the GLD, whatever it is, this is probably an asset or probably a pattern that is going to work well for you in the long term. So long as you're able to identify it beforehand. It's not easy, don't get me wrong. Like, this was only apparent back in 2020. And it did give you another entry, but it definitely was not like how the opportunity arose down here. So these patterns, multi-decade patterns that normally happen on commodities, or I was going to say Forex pairs, but not really. So I guess it's just commodities, really. So pay attention to those on stuff like oil, on stuff like gold, on stuff like platinum, silver, whatever it is. In this case, we do see it on gold. And this is one of the first times I've personally even seen this pattern ever create itself. So if you guys need to see it without the actual chart itself, I know it's a little bit complicated to understand what it looks like just with the chart. Here's a visual of it. So price reaches its peak, right? Because normally if it is a multi-decade move, it's going to come at the expense of an all-time high. We go and trade lower. Here is your sideways trading. You break out of there. Price now wants to come and trade back and get its hand back in that cookie jar. But we don't actually trade right back into that neckline here. We trade right above it. We literally hover right above it. And price breaks out. Now, this is essentially what the pattern would look like. This is not an easy trade. This is not something easy to trade. Just because you don't know when that reversal is going to hit. Mind you, you could be using your moving averages and it could give you an idea. But notice how price trades below these moving averages every time. At least in that larger accumulation phase. So if you guys want to learn more, I will be doing another video. Like I said, for paid patrons only. But in this case, this is all the patterns that are pretty popular, pretty common within the financial markets that you guys can use to your advantage. And practice makes perfect. And you'll never be perfect, ever. So just keep practicing. That's really all I gotta say. Anyway, I'll see you guys in the next video. Take care.